The persistence of the oil price shock, the evolution of business investment, and the bank's assessment of the economy's capacity will also factor importantly into our decisions about the future stance of monetary policy, the Bank of Canada statement said. Related, the central bank's statement was more cautious compared with its earlier communications, analysts said. For instance, the central bank noted signs are emerging that trade conflicts are weighing more heavily on global demand and acknowledged there is less momentum in the Canadian economy going into the fourth quarter. The Bank of Canada also suggested that due to downward historical revisions to Canada's gross domestic product, there may be more room for the economy to grow without stoking inflation, a development that could result in a slower pace for future rate rises. TD Securities said that was perhaps the most telling passage in the central bank's statement, and added that a rate rise in January was unlikely. Canada's central bank sets rate policy to reach and maintain 2% annual inflation. Economists surveyed by the Wall Street Journal earlier this week indicated the Bank of Canada would keep its benchmark rate unchanged on Wednesday, and the majority penciled in a rate rise in January. The Canadian dollar lost roughly a cent in value against the US dollar shortly after the rate decision was released and hit a fresh 6-month low, and a sign traders don't believe another rate increase is imminent. Market odds for a January rate rise dropped to around 40% on Wednesday, from about 65% to 70% earlier this week, according to trading in overnight index swaps. The path to neutral is clearly more uncertain than just a couple of months ago, said BMO Capital Markets economist Benjamin Reitzes. He said the central bank will need to see a solid run of data and steady oil prices to consider raising the key rate in January. Bank of Canada Governor Stephen Poloz is scheduled to deliver a speech Thursday in Toronto, at which time traders may get a broader take on the central bank's outlook and plans. Oil from the Canadian province of Alberta has in recent months traded at a sizable discount compared with West Texas Intermediate, the U.S. benchmark. In response, the Alberta government ordered a reduction in crude production, effective January 1, of nearly 9%, or 325,000 barrels a day. The Bank of Canada said oil prices are down sharply from October, which it said reflected a combination of geopolitical developments, uncertainty over global growth prospects, and the expansion of shale oil production in the U.S. benchmarks for Western Canadian oil have been pulled down even further by a lack of pipeline and rail capacity and the subsequent buildup in inventories, the central bank said. In light of these developments and associated cutbacks in production, activity in Canada's energy sector will likely be materially weaker than expected, the Bank of Canada said. Write to Kim Macrael at kim.macrael@wsj.com.